Welcome to CFI's Financial Modeling and Valuation course on mining companies. This is a really interesting application of advanced financial modeling techniques. In this course, we're going to take a feasibility study for an asset and turn that into a financial model. We'll be using geologic information about a mining company and layering on engineering studies to actually get a cash flow model that tells us what this mining asset is worth. This is truly an advanced application of financial modeling on the mining industry. This course, unlike some of our other ones, is going to focus super heavily on the assumptions and the drivers of revenue for the business. In mining, there are so many things that factor into revenue, such as ore types, grades, recovery rates. It's a very complex type of business to model above the revenue line. So we're going to get into some really interesting things in this course and show you what an advanced model looks like with tons of assumptions. To complete this course, you're going to watch the video lectures where we show you step by step how to build the model in Excel. Then you'll complete a model on your own, and you'll have the confidence to build this model step by step yourself. You'll have quizzes and tests along the way to make sure you really understand the concepts in this course. This is one of the elective courses in CFI's FMVA certification program. Financial modeling is one of the core concepts, and this applies an industry-specific case study on how to build a model for a mining company. We hope that by completing this course, you'll have a broader context and deeper understanding of how models work in different industries. Introduction to mining. Let's take a look at the mining life cycle. Assets is the broadest term we can use in mining, and it includes both projects and operating mines. Within projects, we have exploration and feasibility stage projects, which are the earliest, meaning they are the furthest away from production. They are focused on locating mineral anomalies, discovering and sampling, resource definition and drilling programs, and some basic economic studies. This is the very beginning of the mining life cycle. From there, projects progress to a planning and construction phase. During these phases, the mine plan is developed, environmental studies are done, permitting is issued, more studies are completed, and construction and infrastructure start to be built. After the planning and construction phase, mines begin operation or production. In this phase, they're actually mining and extracting the ore from the ground, then processing it by crushing, grinding, and producing the various types of metal that are contained in the ground. After production and operation, there is the closure phase. During the closure phase, site cleanup and reclamation take place, as well as environmental monitoring on an ongoing basis. So this is the full cycle from start to finish of mining assets. Let's take a look at the technical reports that are produced over the mining life cycle. If we look at a time scale here, with years away from production on the left being the highest, and 0 meaning that the mine is in production on the right, we can take a look at the various studies that are done along the way. So the furthest study that's done is a scoping study. This is a very rough estimate of the amount of contained metal in the ground, and it doesn't include any economic information about extracting that metal. So this is really the beginning of the study phase, the scoping study. It could be at least 10 years out. Getting a little closer in the timeline, at 10 to 5 years away from production, is the PEA, which stands for Preliminary Economic Assessment. As the name implies, this is a very early stage estimate of what the economics would look like from mining and processing and producing metal from this mineral asset. Getting a bit closer now, 3 to 5 years from production, is a prefeasibility study. As this name implies, it is not quite a feasibility study, but it contains a lot more detail than the preliminary economic assessment and continues to refine capital cost estimates, operating cost estimates, and a more developed mine plan. 3 to 1 years away from production is the feasibility study. This is also sometimes called a bankable technical report, where a lot of detail goes into place and a final go or no-go decision is the result of this study. Once the mine begins operation, for many mines it can be a very long life, and over the period of that life, technical updates are provided along the way. These updates include updated reserve and resource statements to indicate the mineral inventory in the ground, as well as cost estimates for extracting and producing from that asset. So as you can see, there's a very long lead time from the very first scoping study all the way to the beginning of production of operation of a mine. Mining companies measure their assets in terms of what's called reserves and resources. In a 2x2 table here, we're going to show you what that means. Across the vertical axis, we have the degree of economic viability. That means the most attractive to extract would be at the top and the least attractive would be at the bottom. And then we've got geologic certainty across the horizontal axis, with the left side having the highest degree of certainty about what's contained in the ground, and the right side the least amount of certainty. So the top left corner is the best place to be. Mining companies start with reserves at the top. This means they have the highest degree of economic viability, and they have a high degree of economic certainty. Within reserves, there are two categories. Proven, that's the best, it's in the top left, and then probable, which is the next best, so it's slightly less geologically certain. Below reserves are resources. Resources are less economically viable, and they have three categories. Measured being the best, indicated having a little less geologic certainty, and inferred having the least certainty. So as you can see, as you move from the bottom right to the top left, you're essentially creating value because you're moving minerals that are contained in the ground to a higher degree of economic viability and more geologic certainty around them. As we build our financial model, we will be watching the reserves and resources that are being tracked in the production of this mining asset. The summation of all these categories are referred to as the company's total resources. Let's review some key terms and definitions we'll need to build our financial model together. Ore refers to the rock that contains material that's economic to mine. These are the tons that will be moving through our model that contain the metal. From the ore, we multiply it by a grade, and the grade is the proportion of material that we are extracting that's valuable. So for example, a gram per ton is the amount of gold that's contained in the ore. And it's important to note that 1 gram per ton is equivalent to 1 part per million, so you can get a sense of how rare some of these metals are. If it was a base metal, it would most likely be referring to the grade in a percentage, say 2 to 3% copper per ton of ore. The recovery rate is the percentage of the metal that's actually recoverable from the ore through the processing methods that are used. Production refers to the amount of metal that's produced each year. In the case of a gold mine, this will be ounces per year. For a base metal, it would be in tons per year. Payability refers to the amount that smelters or refiners will pay per ounce of precious metal. So typically it's 99% or higher. The difference between 99% and 100 represents their fee. The cash costs are the mine site operating costs to actually produce and sell the gold. It includes things like mining, milling, labor, energy, and consumables. The all-in costs, or all-in sustaining cash costs, includes everything in the cash costs and more. It includes all these mine site costs plus corporate G&A, which is the corporate overhead, sustaining capital costs to keep the mine operating, and capitalized exploration. So this is a true economic picture of the cost of extracting metal. We will be covering all of these in our financial model together. We should note, however, that the all-in sustaining cost typically does not include interest or taxes. Now let's review the financial concepts that we're going to need to fill in our financial model. We're going to start at the top of the model with revenue. Revenue is going to be a function of ore in tons, multiplied by the grade, multiplied by the recovery rate, then multiplied by the payability, and finally multiplied by the metal price. This will not all be done in one formula, but these are the steps to get to revenue. Mining properties often contain royalties that have to be paid out. They typically go to very early stage geologists or companies that discovered these properties. And so we will model the payout of a net smelter return, for example. Operating costs for the mine include things like mining, milling, and processing, and they're typically expressed on a per ton basis. Capital costs are typically divided into two categories: the initial development capital, which is for the construction of a new mine, And then sustaining capital, which is the ongoing equipment and ongoing requirements to keep the mine operating. Reclamation costs are incurred at the end of a mine's life. They are accrued for accounting purposes, but not in a cash flow model. We will simply expense them at the very end of the mine life. Depreciation is typically calculated on a percent of production basis. We will show you how to model that, of course. When it comes to taxes, they can often be very complicated, with all sorts of mining-specific related agreements and taxes and deductions. So there's a lot of detail that can go into that, and that's out of the scope of this course, where we will have a simplified tax assumption. Finally, there are the changes in working capital. The three main accounts we're going to model are accounts receivable, inventory, and accounts payable. Once we know the changes in working capital, and combined with all of the other items above, we're able to calculate the annual free cash flow. And that annual free cash flow is going to flow into our discounted cash flow model and allow us to calculate the net present value of a mining asset.
Continue learning. Join CFI today.